Welcome to the deep dive. Our mission today is to really cut through the noise of what was a remarkably confusing week in the markets. We're looking at that final period leading up to December 1st.
Right.
We've got a whole stack of sources here, economic data, Fed reports, and we're just going to try and pull out the essential knowledge you need to get up to speed fast.
And it was a truly pivotal week to cap off November. I mean, on the surface, if you just looked at the headlines, U.S. stocks ended with this huge rally, just pure enthusiasm.
Absolutely.
But when you start to scratch beneath that, you find the underlying signals, at least domestically, were raising more concerns about a softening economy than they were about inflation.
And that tension is exactly what we need to unpack. You have markets soaring while the economy is visibly cooling. That's the central conflict here.
Yeah.
We have to focus on why investors suddenly got so convinced the Fed would be forced to ease policy, and probably sooner rather than later. And to do that, I think we have to start right where the weakening was most apparent.
The U.S. consumer.
The U.S. consumer.
That's exactly right. The reports we got early in the review period, especially the ones focused on consumption, were a genuine shock to some analysts. I mean, they suggested the engine of the U.S. economy is not just slowing down, but maybe sputtering.
So let's dig into that. Tuesday's reports, retail sales, always a key one, came in way below what people were expecting.
Yeah, we only saw a 0.2% increase. The expectation was double that at 0.4.
And that's a steep drop from the 0.6 we saw just the month before.
And you have to remember, this isn't just a random number. We are heading straight into the high-stakes holiday season. So that weak print suggests consumers may have been pulling back before Black Friday.
Not what you want to see.
Not at all. Not if you're banking on a strong finish to the year.
And then on top of that, we got this staggering drop in the Conference Board's Consumer Confidence Index. Confidence is so important because it's about willingness to spend tomorrow, right? Not just what you can spend today.
Indeed. That index landed at 88.7. The expectation was, 93.3? So a huge miss. But here's the really critical context.
Wow.
That reading is the lowest it's been since the 4-year low we saw way back in April of 2025. When confidence drops that sharply, it tells you the collective mood is deteriorating fast.
So it sounds like domestic demand is losing steam pretty quickly. But for the Fed to really pivot, they have to worry less about prices and more about growth. So what was the inflation side of the story looking like?
The inflation reports were mixed, but I'd say decidedly less concerning than the growth reports. The Producer Price Index, the PPI.
Right, the wholesale prices.
Exactly. What businesses pay before it hits the consumer. That met expectations, a modest 0.3% rise. But the devil, as always, is in the core reading.
The one that strips out food and energy.
Precisely. And that core measure came in below expectations. It was up just 0.1% versus the 0.2% they were looking for.
Okay, so that's meaningful.
It is, because it suggests the underlying stickier inflation pressures are decelerating a little. That's a small win, but it's a win for the disinflationary story.
So we have weak consumption, slightly softer wholesale inflation. That's already starting to build a case for the Fed to ease up. But there's still a big release everyone is waiting for, right?
Oh, yeah. Everyone is holding their breath for the shutdown-delayed PCE price index.
The Fed's favorite.
Their absolute preferred gauge. And unlike the CPI, it uses a shifting basket of goods, includes other services. It just gives the Fed a broader view of what people are actually spending on. A surprise there could totally change the calculus for the Fed's decision next week.
And we can't forget manufacturing. The ISM data we got on Monday just confirmed that sector is still struggling.
Yeah, it fell to 48.2, missed expectations, and that's its lowest level since July. Anything below 50 means contraction.
So when you look at that trifecta week, consumer, softer inflation inputs, and a cooling manufacturing sector, you start to build a really powerful case for an economy that's struggling to maintain altitude.
Right, and that's exactly what forces you off the spreadsheets and down to the ground level.
Which is where the Fed looked next with its anecdotal report. The Beige Book.
The Beige Book, exactly. This is the qualitative report, It's compiled from the 12 Fed districts, and it tells us what businesses and consumers are actually feeling on the street.
And what was the big takeaway from that? What jumped out?
The Beige Book gave us more vivid evidence that we are firmly entrenched in what people have been calling the K economy.
The K economy. We hear that term thrown around a lot. Maybe let's just define it clearly for everyone listening.
Sure. It just refers to a recovery that's bifurcating. It follows the shape of the letter K. One arm, the top one, is going up. That's the wealthy, certain industries, high-skilled workers. They're all thriving.
Spending robustly.
Spending robustly. But the other arm, the lower part of the K, is going down. That's lower income groups, small businesses. They're struggling, burning through savings, and pulling back spending.
And the Beige Book had specific evidence for this.
It did. It pointed to strong, resilient spending by the wealthy, especially on things like high-end services and travel. That's the stuff that props up GDP.
Right.
But it was contrasted sharply with weak and even weakening spending by lower-income households. They're relying more on credit, and those pandemic-era savings are running out. And the report also noted that employment weakened slightly, which is consistent with a cooling labor market, while inflation rose only modestly.
It's fascinating. You combine all of it, the soft consumer data, the cooling ISM, this K-economy evidence from the Beige Book, and the whole narrative just shifts on a dime.
It does. It becomes much more about concern for economic softening than it is about a resurgence in inflation.
And that perception shift was immediate. It totally changed how investors viewed the Fed's next move.
Oh, completely. They stopped looking at the Fed as an inflation fighter and started looking at the Fed as a recession preventer.
So how quickly did market expectations actually change?
Exponentially.
Yeah.
I mean, investor expectations for a December rate cut, a 25 basis point cut, they just soared. The probability jumped to a stunning 87%.
87, wow.
And think about that path. That's up from 81% just last week, and it was only 45% 2 weeks ago. Investors went from being uncertain to being virtually convinced a cut is coming.
That is a massive leap in conviction, but isn't that, I don't know, a little dangerous? Markets are rallying aggressively on what is fundamentally bad economic news.
It is. They are betting on a policy rescue. That's the essential question underlying this entire rally. Investors are playing a timing game. They're betting the softening will be just enough to force the Fed to pivot, but not so much that it triggers a deep recession.
The elusive soft landing.
The elusive soft landing. If the economy keeps cooling just right, the rally is validated. If it stops cooling, or if that PCE number comes in hot, this rally just evaporates.
Okay, let's transition from the signals to the markets themselves.
Yeah.
Despite all this mixed, softening news, U.S. stocks finished November with a really powerful surge.
They did. All major segments were up around 2% or higher in that final week.
And this is where you really see investors acting on those hopes for a Fed pivot. But you said it wasn't a universal risk-on ride for every single stock.
No, not at all. We saw a very distinct and I think a highly meaningful rotation within that rally.
Okay, let's break that down. Who lagged and who suddenly surged back to life?
Well, the high-growth tech stocks, the darlings of 2024, they actually lagged over the course of November as a whole. Then NASDAQ was down 1.5% for the month. Growth stocks down 1.7%.
They were already priced for perfection. They need that growth to continue.
Exactly. Which the current data doesn't really support. So the money rotated out of that and into the sectors that stand to gain the most from rate cuts.
Value and small cap plays.
You got it. Value stocks, those established, less speculative companies, they were up 2.5% for the month.
And the small caps, the classic barometer for domestic optimism.
They absolutely stole the show. Small cap stocks produced a stunning 8.5% rally in just the last 5 days of November.
8.5% in 5 days.
Just think about that velocity. It shows massive conviction that the domestic economy is about to get a major shot in the arm from Fed easing, making those smaller, more U.S.-focused companies look really attractive again.
That speed is incredible. I mean, just looking at the weekly returns, large caps up 1.6, growth up 1.6, value up 1.9, NASDAQ up 1.8, but small caps led the pack, jumping 2.3%.
It's a bet on the future health of Main Street, not the present. That's the perfect way to put it.
So investors are heading into December with massive hopes tied to this precise outcome. The Fed cuts, we get a soft landing, we avoid recession.
And historically, that's an extremely bullish environment for stocks.
And of course, every year around this time, we have to talk about the Santa rally. Is there actually data to back that up?
There is, and it's pretty compelling this year. Historically, stocks are positive 73% of the time in December. But here's the interesting part.
Okay.
When the S&P 500 is already up over 10% through November, which it was this year, up 17.8%, that success rate jumps even higher to 78% of the time.
So history and momentum are both tilted positive. That's a strong data point. And globally, we saw some of that positivity too.
We did. Developed markets were up 2.1%, emerging markets up 1.2%. They definitely benefited from the bullish sentiment. But the most important international news this week introduced a sudden fresh layer of volatility right into the bond market.
We have to talk about the major news out of Asia.
The speech by the Bank of Japan Governor Kazuo Uedo.
A blockbuster event that a lot of U.S. investors were probably not paying enough attention to.
It was hugely consequential. Uedo strongly suggested the BOJ, the Bank of Japan, will raise interest rates again later this month.
And for context, this is a central bank that has spent literal decades trying to fight deflation and keep rates near zero.
Or below zero. This is a seismic shift. They're finally emerging from this ultra-dovish policy because they're seeing some modest but persistent inflation and wage growth. So rates in Japan are now rising to their highest levels in 17 years.
So how did this massive global policy change hit U.S. bonds? Because when a major economy tightens, it sends ripples everywhere.
The impact was immediate, and it was bad for bonds. See, when Japan tightens, it raises the cost of capital globally. Japanese investors are huge holders of U.S. treasuries, and now they're getting better yields at home.
So they have less appetite for our debt.
Exactly, which forces yields in the U.S. to rise to compete. We saw an immediate sell-off, especially today. The yield on the 10-year treasury rose 5.8 basis points over the 5 days.
But the real drama was today.
That's right. 7.9 basis points of that rise happened just today alone. It closed the week at 4.9%. The BOJ news tightened global rates and fought directly against that domestic narrative of easing.
Okay, let's step back and just synthesize this one last time for you. What really stands out most is this profound dichotomy you've laid out. We have a powerful surge in the markets, a rally built entirely on the expectation of rate cuts.
Right, on expectations.
And that's contrasted sharply with weakening consumer confidence, softening retail sales, a contracting manufacturing sector. The market is running on fumes of future easing, not on any present strength.
Precisely.